Okay, so today we'll be looking at the first part of group financial statements. The basic parts, the principles behind group financial statements. That's what we'll be looking at.
Okay.
So when you look at group accounts, there are two things that should come into play. That is the subsidiary and the parent company.
Okay.
The parent company, obvious, is that company, assumably so, is that company that has more than 50% of the voting rights. Whereas a subsidiary is an entity that is controlled by another entity, which is the parent company.
Okay.
So in short, a subsidiary is a child, in a way is a child to the parent company because it is dependent on the decisions that the parent company may or may not make. So its existence is entirely dependent on the decisions that the parent company may or may not make. You know for sure that if you don't make any decisions, the company can still go down. If you make wrong decisions, again, the company can go down. If you come up with a decision of not making any decision, the company can be affected still. So we have actually said that that company, which is the parent company, is assumed to have more than 50% of the voting rights. So if this company has control over a subsidiary company, it means that the company shall have the mandate to prepare consolidated financial statements. In this case, we're actually looking at the income statement or the statement of comprehensive income. We are actually looking at the statement of cash flows. We are looking at the balance sheet, which you now call as the statement of financial position. But let's first look at the underlying principles of consolidation. There should be principles that we should follow. One is substance over legal form. Secondly is control and ownership. I'll draw you into the basic arithmetics of consolidation. That is what we are going to spend a bit of time just to understand these concepts because they will help you. Yvonne, they will help you as we move forward, as we start now looking at slightly advanced subtopics within the consolidation of group accounts.
Okay.
So the first assumption is that let's assume that the parent company is buying the equity shares, 100% equity shares in the subsidiary company. So I think 100% parent plus 100% subsidiary assets and liabilities, ignoring the investment in subsidiary. So all you're actually doing here, you check the financial statement, the balance sheet in this case, or what you're calling a statement, the financial position. But I'll maintain the balance sheet
Okay.
throughout the course, throughout this course.
Okay.
I'm not going to change. So assume that if you have the parent company's balance sheet, and you have the subsidiary company's balance sheet, all you do, you just add them at 100%. Whatever element you get under assets plus the elements under the subsidiary. The only thing you ignore is investments in subsidiary.
Okay.
So we have 100% per share capital and share premium. What you do under this case, on equity, you only pick the share capital of the parent company. That is inclusive of the share premium. Ignore the subsidiary.
Okay.
Because these things are crossing out with the investment in the subsidiary up there. So those two components are the ones with time that you're going to learn that they are fundamental, or they're inputs to your goodwill computation. Then your balancing figure obviously will be found under retained earnings. If you have done the correct thing with your assets and liabilities at 100%, you have picked 100% of the parent company to balance it. Retained earnings becomes the balancing figure. No matter how complex the questions are, if you have done the correct things in these other areas, retained earnings, even if you don't do whatever, you just use it as a balancing figure. But obviously you will learn the science behind the computations of retained earnings. So let's look at example 1, basic consolidation. It reads, Namakau acquired 100% of the equity share capital of Sakwa. Let me correct this first. Let me correct it. I always make these errors. Okay, and then I save and go back there. Okay, so I'm saying that Macau acquired 100% of the equity share capital of Sakwaha on the 1st December 2018 for 1 million kwacha. The financial statements of the two companies at that date were as follows. We have investment in Sakwaha, meaning that Namakau has actually bought shares in Sakwaha, which is 1,000. Then we have these other assets, or total assets. We have equity share capital for Sakwa, which is 250, and retained earnings of 750, which takes you to 1,000. We also have liabilities, and we can find the total equity and liabilities down there, which would actually balance with the assets up.
Yes.
So, if you check on this number here, the 1,000, this is the investment made by Namakau in Sakwaha. So if this is equity investment, so this is equity investment. So meaning what has been bought by Namakau are these two. These two. Nothing else. That is the only area which has equity. Equity, ideally, it is actually the shareholders' contribution to the business. So all we are actually saying is that on all the assets, apart from investments, you add them at 100%. So you add these at 100%. You add at 100%. So that is the first part, meaning that this investment in Sakwaha crosses out with these two. That is what it means. Then here, this is at 100% P and S, the subsidiary. These are the basic principles. Whereas here, it is just 100% for P. This one we said it's a balancing figure, but let me just complete the theory here. This is the balancing figure. If you forget the theory, you use this as a balancing figure as long as you know all these other elements. But what it is actually, on the retained earnings, is the 100% from P plus the what we call post-acquired profits. Attributable to who? Attributable to the parent company. So it's the post-acquired profits. Subsidiaries, let me just do like this. Subsidiaries post-acquired profits attributable to the parent company. But here, since it's 100% subsidiary or 100% acquisition, we'll assume that that balancing figure that you get is S's post-acquired profits, because there is no other shareholder who would actually claim the profits being made by Sakwaha other than Namakau, because Namakau is actually the owner or bought 100%, has full control. Yes, even if it was 51%, Namakau will still have full control of Sakwaha, but has full access to Sakwaha's post-acquired profits. So quickly add these two. Do your consolidation. Quickly. I'm giving you about 2 minutes.
Okay.
I guess you are done. Yvonne,
Yeah.
you are done, isn't it?
Hello.
You are done. We can move on. It's balancing, right?
Yes.
Okay, thank you. Thank you.
Yeah. I'm using a phone now today.
Eh?
Okay.
Uh-huh.
Yeah, it's balancing.
Okay. So I do like this. Mhm. Okay. And we remove the video again. So we move on. Mhm. So we move on, we go to another segment. So example 2.
Okay.
It is basically a continuation of what we looked at under Namakau. So we are saying, following Namakau's acquisition of the 100% of Sakwa's equity share, capital of Sakwa on the 1st December 2016, both companies continued to trade. The financial statements of the two companies at the end of the following year, 31st December 2017, were as follows. So we have investment in Sakwa, which is still 1,000. But remember that now Sakwa has been trading after Namakau bought the shares. So we are bringing in a concept of post-acquired profits. So whatever profits that was made by Sakwa after the acquisition of Sakwa by Namakau, that profit will actually be added as part of retained earnings. So we are asked to prepare the consolidated statements of financial position for the Namakau Group at the 1st December 2017. So we know that this one is going, but only this one is also going. Here, what we have, a part of this is actually going as well. So what it means is that if you add 250 plus 900, it takes you to 1150.
1150.
Less 1,000. It actually leaves you with 150. In short, the best way to look at it would be, remember that at acquisition, there was only 750. This is the retained profits. Post-acquisition, you have 900. So meaning whatever profits was made after it was acquired, actually this is both posts, the 900, sorry, I shouldn't deceive you. The 900, let me do this. Let me just try to write it nicely. So the 900, the 700, we are actually saying this was at acquisition. Whereas the 900 here, the 750 at acquisition, the 900, it actually includes the at acquisition and the component of post acquisition. So what was actually what would regard as post acquisition of the 150. So meaning that all these 250 goes, the 900, the only part that remains will be 150. So you add plus 150 here. So this goes 1,000. These at 100%. This one as well at 100%. So I'm giving you about 3 minutes to just consolidate this. Okay, are you done? Is it balancing?
Yes.
Okay, so we can proceed.
No.
It's not balancing.
No.
Okay,
Maybe it's because I'm using the head to calculate.
Yeah.
Okay.
So the way it's supposed to be. Let me just bring in the whiteboard here. Oh, not this, the whiteboard. So you have other assets. Sorry. Or just write on top those things that you might write as whatever, as at what. But you have other assets here. These other assets could be property, plant and equipment, blah, 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 blah. Which is 1,900 plus 1,450, I think, yeah.
150.
How much do you get?
2,350.
So you have 2,350. This is on assets. I'll just do like this. Then you have equity, share capital. So share capital, you only pick for the parent company. Share capital only pick for the parent company, which is 1,000.
Okay.
Then retained earnings. Retained earnings.
Okay.
You have for the parent company, which is at 100%, which is 1,400 plus 150.
Plus 150.
Yeah, plus 150. It takes you to 1,550. Then you have your liabilities. So here maybe we'll say this is equity, which is 2,550. Then you have your liabilities. You pick the whole 100%.
$800.
Which is 800.
100.
Which is 800. Here you deceived me. This is supposed to be 3. It can be 2,000 because this is 19 plus 1,450.
It's supposed to be 3,3.
Yeah.
Yeah, it's 3,350.
So this one here, just try to add. It's supposed to give us 3,350 to balance it up.
50.
It's okay, isn't it?
Yeah.
I guess it is. Thank you.
Yeah, it is.
Sorry. Okay. Now we bring in a concept of non-controlling interest. It's a very key principle. The first two examples that we looked at, Yvonne, we assumed that the parent company was buying 100% of the equity shares in the subsidiary.
Okay.
It may happen like that in real life, but not always. There is a possibility that the parent, but that the other company, or that would, which is assumed to be the parent company, can buy at least more than 50% shares, not 100. So the question is, who has bought these other shares? Is some other equity shareholders, other interest groups. But the very fact that they hadn't bought the majority shares, currently, they are actually called NCI, the non-controlling interest.
Okay.
Those days, they used to call them minority interest. I believe everything, people, this world we are living in, we have become too sensitive that it sounded maybe a bit discriminatory, and there was need to change it from minority interest to non-controlling interest. But the meaning is still the same, because if you are not controlling interest, meaning that you cannot control anything. Yes, you have bought shares, but you have no voice.
Yes.
So changing from minority interest to non-controlling interest, the sum effect is zero. So as a control is exerted to a shareholding of greater than 50%. So therefore, it is not always necessary to fully own a subsidiary, and that's what I've mentioned. So as the parent 75% holding still maintains control of the assets and liabilities. As long as you have bought more than 50% of the equity shares, you still have 100% control of the subsidiary. And therefore, you should actually consolidate on a line-by-line basis, 100%, save of those few lines that we have already explained.
Okay.
But it is very necessary to account for 25% ownership interest, which then comes between the equity segment and the liabilities. That is where you find the non-controlling interest, the NCI. And the way it is positioned in the group accounts, on the statement of financial position or the balance sheet, as I said, is logical. It's logical in the sense that, yes, they are equity shareholders, but they are a form of liability. So they sit between your equity and your liabilities. So I say it is shown in the equity section of the consolidated statement of financial position, but slightly below the equity being held by the parent company.
Okay.
So the non-controlling interest is measured using either of the following methods: proportionate share of net assets or fair value. So you have bought, for example, okay, the total assets, say it is 500 kwacha, and you have bought 75% of the shares in there. If you're actually using proportionate share of net assets, it will be 500 times 5%. Let me just explain this principle properly.
Okay.
So, just to explain the two principles, if we are looking at proportionate share of net assets, I'll just do like this. Proportionate share of net assets. For example, the book value of the assets of assets for the subsidiary is 500 kwacha. So here, if you have 75% parent company, 75%, P75%, or P75, that shouldn't sound like it's a probability of, so you get your 75% of that. So you have 75% of that. Oh, no. Which will be, is it a 7? Is it a 750, something like that? This is proportionate because you're looking at the book value and whatever. But if you find that, yes, the assets, book value is 500, but after they did the fair value measurement, these assets, they are maybe 600. So meaning that you use this 600 times 75%. Times 75%. I don't know what is 75% of 600.
I don't have a calculator here. Let me calculate from the phone. 600 times 75%. 450.
So we move on.
Yes.
Okay, so that is on the non-controlling, where say is measured using either of the following methods. I know the example that we are making, it was like for the subsidiary. For the parent company, still the same concept when you're trying to compute goodwill. But even for the NCI, you can either use the proportionate share of net assets or the fair value. If the exam has given you fair value numbers and the examiner hasn't stated which method you should use, assume that you assume that the computations will be based on the fair value. You've gotten me?
Yeah, I'm getting it.
So example number 3, where now we are looking at the non-controlling interest. It says Peter acquired 80% of Sangwa's equity share capital on 31st December 2017, when Sangwa's retained earnings were 750,000. The financial statements of the two companies at the end of 31st December 2018 were as follows. Investment in Sangwa Company, 800. Other assets, we have that. But then down here, we are asked that prepare the consolidated statement of financial position for the PD group at the 1st December 2018, assuming the non-controlling interest is measured using the proportionate share of net assets. Okay? So,
yes.
Here what we'll do, we'll come up with some stages on which we can actually do this computation, which you should actually be following.
Okay. Okay.
Are you able to see the whiteboard?
Yes, I'm seeing it.
Okay. So I'll start with the working one.
Okay.
So we'll start with the group share. So on the group share,
Okay.
we know that the parent company has 75%. Whereas the NCI has 25%. Let me just check on my network. My network is not clear. Are you able to hear me? Hello?
Yeah, I'm getting you. Is it 75 or 8?
Let me just check. Oh, it's 80. It's 80. Sorry, it's 80.
Yeah.
Okay, let me just check on my network.
Okay.
So it's 80. Let me just delete this. So we have 80%. NCI, then it's going to be 20%. Okay, that's working one. Working two, will be on the assets. We call it net assets. Net assets in the subsidiary. So there'll be three columns here. We'll look at report date. At report date, at acquisition, then at post-acquisition.
Yes.
Okay. So what you put here, the elements, you just do copy and paste what is under equity in the balance sheet. So if I check on the question, what is under equity is share capital and retained earnings. That is what we have. Share capital and RE. So at report date is what is in the balance sheet, which is the share capital at 250. Whereas retained earnings of 900, giving you 150. So at acquisition, we are actually told Piris acquired 80% of Sangwa's equity share capital on 31st December 2017 when Sangwa's retained earnings was 750. So we know that the retained earnings was 750. This one will be 250, usually does not change, even in the exam. So post-acquisition will have nothing there. The difference there, you're going to have 150. This table is very important. You have to memorize it because we'll be using it in the subsequent computations.
Okay.
So like this column here, we'll be using it in the computations of goodwill. Whereas this column, we'll be using it in the computations of RE and NCI. So even this will be and goodwill and NCI as well. So it's a very important, it's a very important table. So working three would be on goodwill computations. Just goodwill, sorry, then just do this. Here we'll be drawing some knowledge from IFRS 3. On goodwill, on business combination, sorry. So the first thing that we'll have to ask ourselves is, under this goodwill, I know we'll not find anything for now, but we need to actually know that at what price are we buying? So we'll need to look at the fair value consideration. What's the fair value consideration? This could be cash or anything. In short, this is the purchase price. So if the fair value consideration is higher than the net assets, then there is some component of goodwill. So fair value consideration in this case, sorry. So we are actually saying a fair value consideration, investments in Sakwa is actually 800. Just 800. So you do like this. But you cannot calculate goodwill without the contribution of the non-controlling interest. It should also be there. So we come to NCI.
Okay.
But with NCI, we'll only look at the at acquisition. This is what we are going to pick. So we'll go to working two and check the value that was there at acquisition. It was actually 1,000. That is what was there. So it is 1,000 times 20%. So like I said, we will not find any goodwill, but it's better you get to know how to compute this goodwill, which gives us 200. So it takes the total value of this particular business, the enterprise value, or at whatever price that it was pegged, it takes it to 1,000. Then the book value, the net assets, you pick what is in there in working two again. So you pick what is in working two. In this case, what is in working two, if you go back to working two, the net assets was 1,000. So zero goodwill. Nothing. Zero, noto.
Okay.
So from working three, you go to working four. Working four will be on the NCI.
Okay.
So on working four, you have On working 4, you have at acquisition, which is in column 2 of that table. So at acquisition, if we go back to table 2, working 2, at acquisition is 1,000, which you had already calculated under goodwill. You can pick it from the goodwill computations, the 200.
Okay.
Which is here, I should have just said working 2 or working 3 from goodwill, because I've already computed it, which is 200. Then post-acquisition, at post-acquisition, you go to working 2, which is the 3rd column in working 2. So the 3rd column in working 2, we have 150, and we are saying we are using the proportionate of net assets. So it will be 150 times 20%, right?
20%. Yes.
How much do you get?
$30 kwacha.
It's 30 kwacha.
Hello?
It's 30 kwacha, so it takes
30.
you. So it takes you to 230.
Yes.
Then you go to working 4.
Working 5.
Oh, working 5. That was working what? Oh, okay, working 5. Thank you. Thank you. So you should memorize this, the flow, which is group retained earnings, GRE, group retained earnings. So under this, you have 100% that is coming from P. From P, 100% coming from P is so 100% coming from P, and the group retained is 1,200. Then you are actually picking less than 5% from the subsidiary. But again, in here, you go to working 2. You go to working 2, or you can still subtract what is in working 4. What is in working 4 under NCI, you can subtract that from the total, but just go to working 2 in column 3. We had 150 there times 75%. It should give us 120, which is 150 minus 30.
Oh. Yeah.
So in short, you are going to have 1,320.
20.
That is what you're going to have. Having done this, now you can consolidate. Now you can consolidate. So you write on top the ceremonial things that you normally write on the balance sheet or whatever as that blah, blah, blah. That is ceremonial. Yeah. So you have your other assets. Okay, we'll say other assets, or we'll just say assets. Let's not waste time, we'll say assets. We have calculated that amount. How much is it? 1950 plus 1450. We said it is 3350.
50.
Then we do like this. We have computed these things. We have equity shares, share capital. You pick only for the parent company, which is 1,000. I'll put 2 columns here just for tightness sake. Not that it means anything.
Okay.
Then you have retained earnings. Retained earnings, which you pick from working 5. From working 5. 1320.
Yes.
Which takes you to 2320. Then you have the NCI. Let's just squeeze it. I didn't have enough space. The NCI, which is in working 4. How much is it in working 4?
230. 230.
Right. Then you have the liabilities. I'll just squeeze them. I just squeeze liabilities there because it squeezes our lives when you have too much liabilities. So liabilities at 100%, which is 500
800.
300, you have the 800.
800.
So when you add these, if what we have done is correct, it should balance up to give us 350. Just check.
Yeah, it's balancing.
Okay, I hope you're appreciating the concept.
It's balancing with it.
Okay. I hope the concept is being appreciated.
Yeah, sure.
Okay. So follow these 5-step workings. No matter how complex the question is, just follow those.
Okay.
Yeah. So on goodwill, I'd already computed on goodwill. I saying on acquisition of a subsidiary, the parent usually pay more for the subsidiary than the value of the net assets. So, because maybe you haven't negotiated well, you are paying more than the value of the net assets, which is basically, goodwill is basically stupidity. You have paid more than the net assets. So to justify paying more than what you should have actually paid, you call it goodwill. Then you go further to justify why you think you have paid more than the net asset, more than the book value of the asset. You start now justifying because of the place where this thing is. You start looking at maybe the 4 P's of marketing: customer loyalty, good reputation, and all these other things. You start justifying. So in short, goodwill is where you have paid more than the net assets of the company that you're acquiring. So that difference is what you call goodwill. You get me?
Yes.
So I'd already shown you how to calculate goodwill. Let me see it through what you're going to do. But you can still do it even at home once you're home, whatever. It's the same concept that I showed you in working 3. Here, let me just explain this. It says
Okay.
the parent company buys 5% of the equity shares in the subsidiary company for 156,000. This is the fair value consideration. P has spent 156,000. Then says the remaining shares were valued at 52,000, and the net assets at acquisition were 170,000. 170,000. So the NCI is 52,000 because that is what is remaining. After buying 75% of the shares at 156,000, 25% of the shares was 52,000. So you add 156,000 plus 52,000, less the net assets at acquisition of 170,000. It gives you the difference. That is a goodwill. You get me?
Okay. Yes.
So we had already explained what proportionate share of net assets is and the fair value of the method, of using the fair value method when we actually introduced this particular topic. So thank you so much. Obviously, the website now has changed. It's consolidation.com. So I'll change that before I post this presentation on the website.
Okay.
Yeah. So tomorrow I'll start off early in the morning going back to Lusaka. I'll be able to give you the position at maybe about 13 or so. Hopefully we can start classes maybe at 18.
Okay.
Yeah, but immediately I'll be able to post the video lecture maybe in the next 1 hour so that you can have time to go through the principles. Thank you so much.
Okay.
And bye-bye.
Thank you.